What's up, everyone, and welcome to the daily macro update for Wednesday, April 9th. Man, what a day in the markets so far. We have about 30 minutes to the close of the market here, and man, it was just a crazy swing. Market volatility has been crushed, but still remains above the 30 mark level with the VIX. And yeah, we got some stuff to cover here today. So welcome to the show. Yeah, so obviously this morning, I'm not sure if you guys saw, I mean, this was all over Twitter, but you know, I'm not sure how legal this is, but Trump put out a tweet saying that it's a great time to buy. And then I think what, 4 or 3 hours later, he sends this Truth Social post out basically saying that I'm actually going to do a 125% tariff on China. But essentially, regarding all this negotiation, I am pausing everything by 90 days. So there's going to be a 90-day pause of these tariffs, which is pretty interesting. But yeah, it's definitely quite the swing here. Now, again, I'm not sure how legal it is to, tell everyone to buy and then, with one swipe of your whatever this is, Truth Social, you're telling people that this was not manipulation. So definitely very strange here. And so, anyways, even with this 90-day pause, it's still with this bump in the market here. We're not necessarily seeing a total reversal in the trend, right? So if we go down here, let me go to the S&P 500. So yeah, pretty massive bounce here. I mean, this is common for bear markets. Bear markets are known to have these wild swings, especially with the volatility index, above 30. For those who are members in our partnership circle, every single Tuesday nights, we have an exclusive session with just our partners. And we were talking about yesterday how when we looked at market breadth, it remains at levels that we haven't seen. Pretty much you can count on your hand how many times it's been this bearish, pretty much since the great financial crisis, if you guys can see that there. And so, we were basically saying we wouldn't be surprised if there was a bounce. We were buying things in the morning. And so it's still, in a bearish trend. The bookshelf in the background is still red. So that doesn't mean that our model is full blown bullish on the S&P, but it just is. This is pretty common with a lot of the different bounces that you could have in a bear market. And so, yeah, I mean, you're going to continue to see crazy bounces like this. I wouldn't be surprised even if it went up higher and had some follow through. But it's essentially a bounce throughout all of the different assets that have been selling off. If you take a look at Bitcoin as well, Bitcoin bounced all the way up to the top end of the range there. And so I wouldn't be chasing this stuff, and that's only my team's viewpoint. We're really just a wait and watch, in a wait and watch pattern at this point in time. But yeah, I mean, you're just seeing a rebound in things that have been selling off a lot. It's not that complicated. Don't overcomplicate things. Don't let your emotions, get the best of you. I know that the Fed minutes did come out here around 2. I have not personally had a chance to look at those. But yeah, you're even having a bounce in oil. Gold continues to even have a bounce. So yeah, I mean, it's just a bounce across the board because volatility was just incredibly high and it's finally coming down. Now, depending on where it closes here, I mean, this is a massive intraday volatility move. And so we'll see where it lands. But if it still remains above 30, this is not just to go out and, chase. Even if you are, trying to trade this like a maniac, you wouldn't just try and chase this green, right? The time to buy is always on red, even if you expect a bounce. but that does go against our process. Definitely not advising that. I'm just saying the psychology of trading goes both ways in bull markets and bear markets when you have large down days with rising volatility. Now, as of this morning, the big concern was taking a look at the rebound in U.S. 10-year government bond yields, really bond yields across the board. A lot of critics of the administration were talking about how, they're failing at their job of getting rates down. Some people were saying, oh, China is dumping their U.S. treasuries, and so that's why yields are skyrocketing. Some are saying that there's a credit event. You really don't know, and it really doesn't matter the reason why this is, having a bounce in yields. What matters is that, it's yields are still in a bearish trend, and this has provided an opportunity to buy, select, bond exposures that have the best trend strength. For those people who are in our macro optics community, I was expressing that this morning. So those of you that are in our school group as well as our partnership circle, you guys know what we were talking about. But we were not, freaking out by any means by a lot of the noise that's been happening out in the news cycle, as well as the Twitterverse or Xverse or however you want to call it these days. But that's pretty much, what I would characterize, things that are happening right now. Huge spike in the mega caps. Take a look at NVIDIA, XLK. Pretty much the things that have been going down the most have the biggest pop. So try not to overthink it. These things, the trends have not changed yet. I'll let you know when they do, if they do, but that's what I'm seeing as of right now. The dollar also remains in bearish trend here. So yeah, craziness going on in the markets. We're seeing a lot of foreign currency markets perform, in a bullish trend still. You have the euro as well as the best performing one, which was the Swiss franc, which, you're kind of getting an opportunity here. But yeah, the Swiss franc remains one of the bullish foreign currencies. Starting to see a little bit of a peak in high yield and credit spreads, as well as, let's see here, the 10-year break-even inflation rate. I don't think the Fed is going to budge next month, though. Where's the 10-year break-even? Where is it? Here we go. Yeah, and that also had a rebound here. And so that's a lot higher than what the Fed wants. So, I wouldn't, unless this really breaks down, I wouldn't expect the Fed to really cut here. And so, right, so the last time they were cutting, where was the 10-year break-even inflation rate? It was all the way down here. And then once they cut, what did inflation do? It rose again, which made them pause. So this is a pretty interesting dynamic. It'll be, we'll see if these tariffs, we're not going to be able to know how the effects of these tariffs actually play out until multiple months from now. If you guys haven't watched Anna Wong's interview on Adam Taggart's podcast, I would highly recommend that you guys check that out. What was it called? Smart Money or something like that. Adam Taggart show. I forget the name of it, but he did a really awesome interview recently with Anna Wong, and I would definitely, she has a way better layout of, the effects and the different stages of, these tariffs. But in my team's view, this tariff situation really isn't the biggest news, because in the background, you're seeing an entire tightening effect within the credit markets. And I highlighted this in a tweet today, and I still have to make a video about it, but let me see if I can pull up the actual chart here. Let me see. Okay, here we go. And we'll get into some macro data as well. But this chart right here is showing, or it's comparing essentially total equity that commercial banks own versus how much credit that they have lent out. So you can almost think of this as equity versus debt. And so when these two things are converging, there's different scenarios. The most important thing right now to understand is that both credit as well as bank equity are decelerating at the same time, which is typically not a very good place to be in the markets, right? We really haven't seen this happen since 2022. And so, yeah, we'll continue to monitor what happens from here, but this gets updated every single quarter. You can track bank credit. I think that comes out on a weekly basis. But seeing these two things converge negatively at the same time is really getting me worried about the backdrop with what's happening in the credit markets, which in our view, it's the most important thing that's happening right now. Because I don't know if you guys remember, but on March 15th of 2020, in response to the COVID pandemic, the Federal Reserve lifted all reserve requirements to zero. So commercial banks do not have to own any reserves on their balance sheet in order to create credit and lend money. And so we are no longer in a fractional reserve banking system. We are in a zero reserve banking system. And this is just giving more control over to the Federal Reserve, less control over to the commercial banks. And although this has provided some temporary liquidity measures in order for banks to stimulate, they just never ended it. Like most government programs, an emergency happens, they enact it, the emergency is over, but do they take it down? No, they just leave it open. Classic, classic powers that are enacted in emergencies and then are maintained after the emergency is over. And so because of this, you really have to pay attention to see if this zero reserve requirement gets out of control. And yeah, this is, in our view, just continue furthering the crazy boom and bust cycles that we're experiencing, post-pandemic. And yeah, so that's the main backdrop risk that we're taking a look at. And what we can do is here we can go over some of the different reports from today. So remember how yesterday there was a 55% chance that they were going to cut in May? Well, after today, look at that. It swung right back to in the 80s. It's now back to an 82% chance that they're going to pause. So this swing in the markets is definitely wild. Yeah, it's pretty crazy time in the markets right now. Commodities continue to decline. Let's see what else is going on. The Kansas City Financial Stress Index did start to accelerate from here alongside credit spreads. We also have the Chicago Fed National Conditions Index. That also continues to accelerate. So this is really the first time this has happened since late 2021, right before the bear market of 2022. That's what's happening in the background. Let's see what else here. I haven't had a chance to take a look at the Fed's minutes. So what we can do is let's see if we can go through some of this together here. The minutes were just released. Let's see. I'll have to review this at another point because it's very large, but usually I like to come down to where it talks about financial markets and open market operations. Let's just see if we can find something. Let's do, they don't call it quantitative tightening, but roll off. Nope. Here we go. Participants assess the balance sheet reduction had gone well thus far. All participants judged it appropriate to continue the process of reducing holdings, almost all participants supporting a slowing of the pace of runoff at this meeting. Most participants noted the importance of clearly communicating that slowing the runoff had no implications of the stance of monetary policy, would not affect long-term path of balance sheet. Was a natural progression of the slowing decided at the May 2024 meeting. Let's see. Some participants noted that a slower pace of runoff will help guard against reserve scarcity emerging with little advance notice during the period of potentially rapid increases in the TGA. Several participants did not see a compelling case for slowing the pace of runoff at this meeting. Let's see. Some participants highlighted the importance of the Federal Reserve ceiling tools and encouraged the ongoing efforts of the desk to improve efficacy of the standing repo facility. Interesting. Okay. All right. So it seems like there's not really any updates on balance sheet reduction other than they're just slowing it. So that was the main thing that I wanted to look at here. Let me see if I can also search. They talked about gold anywhere? Nope. Let's see. We talk about U.S. equity prices decreased notably on net over the intermittent period without particularly pronounced declines in technology and cyclical, with particularly pronounced declines in tech. While trade-related news had been the most prominent driver of equity price movements, the manager also noted that risk management considerations have led to some levered investors reduce long equity positions. Okay. I'll have to, let me see if I can. Last thing we'll check is the reverse repo. Okay, the manager observed that the RRP facility had reached a post-2021 low of under $59 billion in mid-February, abstracting from the debt limit situation with the RRP nearly depleted. Portfolio runoff was likely to translate to lower reserves in the future. Wow, so they're actually acknowledging that the RRP is drained, right? This is really the first time that we've had a direct comment by the Federal Reserve that the RRP is drained. And because of this points to reserves remaining abundant, but the reliability of the signals provided by those indicators was starting to be impaired by the debt limit situation, which was already affecting the Federal Reserve liabilities. The Treasury General Account had declined nearly $300 billion since the debt issuance suspension period was declared in January. As a result, reserves were about $180 billion higher. RRP balances had also increased somewhat. Reserves were likely to continue to grow except for periods around tax dates until a resolution of the debt limit situation, and then drop quickly as the TGA is rebuilt. In that scenario, reserves could potentially reach levels below those viewed by the committee, which is $6 trillion, as appropriate without market indicators being able to provide much advance warning. The manager noted that either pausing or sufficiently slowing runoff would provide meaningful insurance against that possibility. More generally, the manager also noted that slowing runoff would also be in an effective way consistent with the committee's plans of addressing the risks posed. A nearly depleted RRP facility. Desk survey results indicate that more than half of the respondents voted to either pause or slow at its next meeting, with the majority of those leaning towards a slowdown. Let's see. Interesting. So they're acknowledging that the RRP is drained and that they're running out of time, and that they might start actually either doing some type of open market operations or potentially lowering rates. I'll go over the rest and make a video about it, but interesting. I just wanted to take a look at those Apologies about doing it live here with you guys. That's kind of like the reasons how I do my thought process, though. But let's see here. Yeah, so Dow surges 1,800 points after this 90-day pause. Pretty incredible, I might have to say myself. Definitely was not expecting that, although, some technical indicators were already pointing towards a little bit of a bounce here. So, yeah, as we get to the close here, we got about 7 minutes until the market close. If this still remains above 30 after the market closes, my team and I are still remaining patient. And, the stock market as well as Bitcoin still have to do a lot of work in order to recapture bullish trend. All right. Now, as you guys can see on this right-hand side here, I have what's called this indicator that we use in order to stay organized in TradingView. This is called our global macro dashboard here. And so in this global macro dashboard is where, we start every single day with, our different currencies as well as bond yields. And we go down the line with what we look at every single day in order to observe the global markets, every single morning before the trading day starts. And so what I did was I created a PDF that essentially goes through all of this information, as well as it goes through how you can use all these indicators for yourself so that you can look at everything that I'm looking at each and every day. It's called the Macro Investing Toolkit, and it's a free PDF. And it goes through, like I mentioned, everything that we track every single morning, each and every day. And if you guys would like to have a copy of this, all you have to do, if you guys are on TikTok or on Instagram, you can just shoot me a DM. Just DM me the word toolkit, and I will send you your copy of the Ultimate Macro Investing Toolkit. And so, this goes through our entire reasoning for what we look at every single morning, which indicators that we like to use, and how to use those, along with our trade pyramid model. So again, just DM me the word toolkit, and I will send you a link where you can, pass along your email so that we know where to send the toolkit to. But I would highly recommend that you guys do that. If you guys are on, YouTube here and you would like access to that, you can just go to one of our socials. Just look up Macro Optics on either TikTok or YouTube or Instagram, and shoot me a DM, and I will send you this toolkit here. And yeah, that's really the main resource I wanted to get out to people as this craziness happens in the markets. And so from here, what we'll do is we'll go ahead and I'll go to the comment section here to answer any one of your questions. And then if you guys would like me to pull up any type of tickers, we can go ahead and do that as well. So starting off with the comments from YouTube, did we break trend on the S&P 500? No, it is still bearish. I was able to sell off a bunch of my gold miners today and actually turn a decent profit on this bounce. Excellent, Nobuki. That's what I like to see, man. Yeah, any type of bounces from here, I would take that as just getting rid of things that, broke trend in your portfolio. So if I was holding Qs, great time to get rid of some right now, right? You have 5 minutes before the market ends. Is the 10-year break even showing what the Fed rate needs to be to beat inflation? No, it just shows the 10-year inflation rate, the 10-year average inflation rate. Yeah, good questions. Let's go over to the Instagram comments here. We got about 26 people in here. Welcome, everyone. Is this an overcorrection if you have a 104% tariff on China? What does anything else matter? Not really sure what that question is, or if there was a question at all. Let's see. We got fake news turning into real news before GTA 6. Chin trades, you're funny, man. You're a funny guy. All right, let's see. Does your process consider put call ratios when looking at charts? Yes, it does. It's part of our sentiment indicators list. But yes, put call ratio, the CBOE put call ratio is definitely important, but it's just one thing to consider. Does the Swiss not cut the rates? Possibly not. With the higher volume sell off in short bonds, would you put them at neutral? No, bonds remain bullish, even with this sell off. I'm very interested in the 7-day trial. It is my spring break next week. I'm a finance major. I want to gain more knowledge in macroeconomics. Is it okay to have a very small capital? Yeah, I mean, typically, for the school community, right? You don't necessarily need any capital in order to start learning this stuff. It's if you're just starting out in markets, the school community is a great place to start. Yeah, definitely would recommend the trial. The toolkit has been so helpful, even more incredible that it's free. Yeah, man, appreciate you guys enjoying it. I'm really trying to turn this around with the way that financial publications work. Since I was in the business for a few years, I understand how a lot of it's a lot backwards, right? So it's very expensive to get these news publications or these, different research publications, and the value that they provide are quite horrendous. Um, Pretty much you pay for these subscriptions and they tell you things that you already know or things that you can just take 5 seconds to look up, and they don't really, show you any type of process for you to follow. And then you find yourself, just getting bombarded with emails to upgrade to different levels, and you're just reliant on some person who you've never met or heard of tell you about some stock that they're picking, right? We don't want just Captain Stock Picker over here. We want to learn an actual process from someone who's doing it for real, as well as so that eventually you can just do it yourself and not have to rely on any type of newsletters, right? So yeah, I think the legacy model of the way that these newsletters work needs to be, flipped on its head, and value needs to be first. And yeah, so just taking my experience from working from one of the big publishers that I was disgusted with, and trying to do my own take on it. What kind of cat do you have? I know he was whining in the background. Um, my wife and I have two cats actually, but yeah, around this time he tends to want attention. But maybe he'll walk over here. I call him my one of my research analysts. He helps me out, with some of this research. What do you think of Q's and the SPY? Is it a day? Is today the day to sell? Yeah, definitely. Not financial advice, but when something remains in bearish trend and it has a pop like this is like a perfect time to reduce exposure or just get rid of it. Even if it continues bouncing, it still has a lot of work to do in order to reclaim bullish trend, which it's nowhere near doing that right now. Yeah, I mean, this is like a gift. This is a gift right now. Look at Qs, look at SPY. This is an absolute gift. Oh, the market just closed. You can probably snag it pre or post market. The cat wants to see the bookshelf green. Hey, I love bull markets way better than bear markets. I make way more money in bull markets. So yes, I do want the bookshelf to be green eventually, but I want it to be green because of math, not because I want it to, right? But yeah. Let's see. Are you using shorts or just wait and see? Yeah, we do have some shorts on. You can buy some put options, but yeah, there are some shorts that we use. The 10% tariff remains in place for commodities. Yeah, there are. It's not a pause on everything. All right, let's go over to TikTok. I know TikTok typically likes to have incredibly unfiltered comments. Let's see. Guess we're out of the bear market? No, definitely not. Pretty sure Trump never intended to go through with these tariffs. Today confirms it. I mean, yeah, I made a video the other day saying that I think this is clearly just negotiation tools to just get better trade, because I think the way that this administration is trying to look at this is improving productivity, but it's going to take a while. And a lot of people think that I'm like overly biased, where I'm actually just for I just want whoever's in the presidency to be successful. I don't agree with everything that this president is doing. I think that the tax cuts for corporations mainly benefits rich people, and really doesn't bring back too much productivity. So I'm pretty critical of that on Trump. There has to be some crazy reform, and ultimately, it's just spending at the end of the day. It needs to really toughen up, because the more that the government spends, the more capital is taking away from the private sector. And a lot of people think, oh my gosh, it's great that the government is spending in these sectors, but just because maybe they're increasing taxes, or giving more money to a certain sector, it's actually taking away from other sectors, right? It's a zero-sum game. It's not like we're just stimulating the economy without any consequences, right? And Trump is definitely no stranger to that, and it's something that I'm still very critical of. One thing that I want to highlight here, I did send out this tweet today. Maybe we can just run through it real quick. But I was talking about how the national debt's almost at 37 trillion, and the debt to GDP ratio continues to climb. It's at the highest level in peacetime, since forever. It's really quite terrible. And since the pandemic, right? So Trump dumped $3.9 trillion in stimulus, and then Biden spent another $4.8 trillion. Both disproportionately increased the wealth of the wealthy. But Trump did it more directly with his tax cuts, and Biden did it more indirectly with inflating asset prices and making things a lot more expensive than they are. Right. And so deficit spending, fiscal year 2025, continues to remain above the 2024 trend, which is absolutely crazy. I mean, this is just totally, totally unsustainable. And again, this is the biggest problem that I'm seeing. And really, the Trump administration is not addressing the spend issue. The top 1% of Americans own 30% of all US wealth. The bottom 50% just own 2.5%. So there's, the gap continues to widen. And as you guys can see here, this gap in share of net worth held by top 1% and bottom percent, where did this started widening? Right around 2023, when budget deficits started to get out of control with the Biden administration. So the percentage of net worth held by the top 1%, Biden loved, or those people loved when Biden was in office, and really it's been decreasing that for the bottom 50%. So for those people who are just one-sided, I'm trying to be critical of both parties spending. But yeah, I mean, both parties have been really spending like crazy over the past, since the pandemic. And ultimately, purchasing power continues to decline. This will eventually, if it keeps going, will end up like, ancient Rome, right? French Revolution, all this craziness. We're on a path right now where interest payments on the debt are going to be the second most expensive thing below social security. in about 7 years or so, 10 years. Hard assets like gold have been completely outcompeting the S&P 500. I don't know if you guys have seen this, but this is gold compared to the S&P. Look at what's happened pretty much since November. Like, if you were taking all of your money from SPY and putting it into gold, I mean, you just won in 2025 so far. And then, like I mentioned beforehand, reserve requirements being set to 0 is really not good. I mean, this is giving more power to the central banks. And then what we just covered with tracking credit versus capital with the banking system. And there's 4 different scenarios. And right now, we've gone from tightening into a bearish trend. And I don't really hear too many people talking about this tightening effect that's going on in the private liquidity markets. So, yeah, that's what I was spending some time on here today. But yeah, interesting things that are going on. Appreciate the follows. Let's get into some tickers. I know that that's what I had promised. Appreciate that, Brandon. Yep. If you had to choose an option, do you think today's rally is a bear market rally or not? I mean, yeah, we're in a bear market and it had a rally, so that's definitely a bear market bounce by definition. So pretty clear there. IG people wouldn't immediately set up shops given the volatility. How do you trade when the market is so volatile? Well, I mean, when the VIX is above 30, that's not necessarily like a trading environment. That's more so of like, hunker down and wait until the storm is over. And then, if the VIX gets between like, maybe like 18 to 25 or so, that's usually a great trading environment. Traders do very well when the VIX is at those ranges. And then anything below 18 VIX, I mean, that's really just where you buy and hold. And that's typically when the markets are boring and they continue to go up slowly. And so, yeah, that's how my team likes to characterize the volatility index of the S&P. And with it being above 30 right now, there's just no reason to try and time bottoms. There's no need to chase. It's really just hunker down time. But yeah, I mean, we do have our core positions still in things like gold, some treasuries, and some other things that still continue to work, or at least not go down as much as other things. And yeah, so that's currently where we're at with our positioning. If you guys want specific positioning, I would highly recommend taking a look at our community groups. Is taking some profits to load up on Coinbase later when we go lower a good plan? I don't have much. I can't give you direct financial advice, BB Veli, but if you're taking profits on a bounce, that's always a good thing. But when it comes to cryptocurrency markets, I don't invest in the cryptocurrency market until it's bullish in our model. And it's currently not bullish in the model, so I'm not touching it. No, Kevin, VIX is the VIX. Crypto markets remain in bearish trend. You have stable coin dominance remaining in bullish trend. So even though it's having a bit of a correction here, if you zoom out, stable coin dominance is remaining bullish, which is really not an environment for altcoins, excuse me. And then same thing when you look at Bitcoin dominance, when Bitcoin dominance is rising alongside of stablecoin dominance, that's typically where, you have that's not altcoin season. And so the way that my team and I like to judge whether or not it's Bitcoin season or altcoin season or no coin season is the relationship between Bitcoin dominance and stablecoin dominance. So alongside, looking at the macro scenario and things like that. So if the macro is pointing to a more risk on environment, and at the same time, you have Bitcoin dominance as well as stablecoin dominance decelerating at the same time, that is typically when you want to be in altcoins, and you do a good job picking altcoins. But we are nowhere near that as of right now. A lot of people, look at some indicators like the altcoin season index, but it's really not as complicated as you guys think. It's paying attention to the macro and looking at the relationship between stablecoin and Bitcoin dominance. You can even add another layer by looking at altcoin dominance, but that usually just goes up during the times that I was just describing. Hey, Johnny, could you please check out and, if possible, respond to my question on yields and yuan above? Let me see. Hey, Johnny, 10-year yields have been going up at least until today's pivot by Trump. A China dumping U.S. treasuries, isn't it counterintuitive given that they're trying to devalue the yuan on one hand to boost up exports? So, I mean, we don't know if yields accelerating is because China is dumping treasuries, right? There's no real way to track that. Ultimately, though, you're seeing demand continue to be destroyed, and so yields typically perform poorly in that environment. And that's really what the medium-term trend is still holding up as. And so these intra-week or intraday moves, even as large as they aren't necessarily telling us anything about that. Because when you take a look at the 10-year government bond yield, for example, I mean, this still remains in bearish trend, even where it's at right now. I was actually buying some bonds when it was around up here. And yeah, that proved to be a good time to buy some. But when thinking about the medium and, or really the medium term, we're still long bonds. When I say medium term, I mean like 3 to 6 months. But yeah, so I mean, when these tariffs are imposed, what you see is, there's a lot of pressure on China. And so one thing that the Chinese government can do, or the Chinese central bank, is start to devalue their currency by printing. And so I think that this trade war is still going to be a catalyst for a lot of money printing by foreign central banks. And so, you could see a continued acceleration in foreign equity markets because of that. But what does that mean? It means that capital is going to continue rotating out of US equities, if that makes sense. That's just what we think. We'll see if it happens, though. Things can always change. Did you join the rally today, or are you waiting? What do you mean, Kai Oken? What do you mean by that? Kai Oken, like Dragon Ball Z? What do you think about the trend for the Chinese market tomorrow? I don't know. I mean, the Chinese market as of right now, let's see, the 10-year Chinese bond yields are bearish. If we go to the Shanghai Composite Index, that broke bearish as well. So, I mean, yeah, it remains bearish in our view. Waiting for an entry. I mean, yeah, if something is bearish, Kaioken, I'm not even thinking about buying it. I mean, I wouldn't think about buying stocks or equities or crypto until it becomes bullish again. But there's other things that you can buy that are outside of equity and crypto markets that are still performing well. That's why that's why with macro optics, our goal is to just look at the entire global markets and see which ones are performing the best and have the best strength on a 3 to 6 month basis. And so that'll point you to that'll point you to the direction of where to allocate money. So yeah, don't just get hyper fixated on just equity markets and crypto markets. There's tons of other things to invest in that you have the ability to do while you wait for a lot of these bearish trends to finally come out of it. Like you don't have to bag hold these different things as they go down. That's a narrative that is pitched by Wall Street in order to have us, keep our money in so that they collect their fees. So I had some friends who were trying to do some 0 days to expiration options. ITA for aerospace. Let's see. This still remains in bearish trend, but I mean, this is a pretty crazy intraday move. It looks like it's trying to reclaim, but I mean, even still, you don't just want to like buy here after it's pumped up like this. I more so meant, do you think it's a short-term rally or long-term? I don't know. I mean, time will tell, but people forget that in bear markets, that's when you have the largest rallies, right? So if we go to the S&P 500, let me see here. Let me go back to 2022. Where did you have the craziest rallies here? Look at this. Back in March, you had a 20-day, almost 12% rally. In June to August, you had a 2-month 18% bounce. Noticed as the S&P 500 continued to fall or continued to go down, the bear market bounces got even bigger. And so these large short-term bounces typically happen in bear markets. And I'm sure, if you guys remember during times where like right here at the troughs of these, that's when people were, super fearful, talking about recessions, all these different, crazy narratives floating around. And, some people like to trade the bounces, but what I'm trying to say here is that a lot of the most aggressive bounces happen during bear markets. So it's not, this type of behavior is not surprising. Like, I'm not surprised that we had a bounce given we had a 13-day almost 15% drop in the entire S&P 500. So of course we're going to have some bounces. Is taking some profits to load up on Coinbase later when we go lower a good plan? I don't have much. I think I answered that question when you asked it on TikTok here. Thoughts on how today impacted QT, QE, or rate cuts? Great question. The impact of today is that more so they're not going to pause, or they're going to continue to pause rates. So during next meeting on May 7th, there's more of a lean towards just continuing a pause. Whereas yesterday, it was actually a 55% chance that they were going to cut. And then in June right now, there is a 62% chance that they're going to cut. Yeah, interesting. Yeah, yesterday there was a 45% chance that they were going to cut by 50 basis points, and then that went right back down to 13%. So it's pretty wild with the swings here. Volatility is just going crazy. I mean, if you take a look at bond volatility with the MOVE index, look at the MOVE index right now. It's at levels that we haven't seen since October of 2023. So this is a rapid acceleration in bond volatility. Thoughts on a silver rally? I'm not sure. Silver is bearish right now, so. Do you believe in buying the dip? No, I do not. Would you take a look at ITA? I did have it on the chart here a second ago. You missed it. ITA still in a bearish trend. Don't chase green candles. Was selling some ITA on the pump. That's the way to do it. That is definitely the way to do it. You have liquid cash but don't want to touch anything right now. I mean, that's good to have cash as long as you're having it work for you, because you can still get 4% on your cash. So definitely just don't have it sitting there. You can put it in a money market fund. There's other places to put it to collect that yield. At least get a third of or almost half of the long-term S&P 500 returns. Let's see. Loaded up on ARX. You're very bullish on it. I don't even know what that is. ARC Resources. Is that what that is? Yeah, I mean, I definitely wouldn't be bullish on something like this, but hey, more power to you. Yeah, it's in my ISA on 4.2%. Well, that's good. Yeah, I mean, that's still a great return compared to the previous decade. But all right, everyone. Well, we're going to go ahead and end it there. We're about at 4:30 p.m. But yeah, if you guys want to learn the entire process of what I do every single morning in these charts themselves, I would highly recommend just shooting me the keyword toolkit. That way I can send you our macro investing toolkit, and you'll have that copy so that you can follow this every single day. For those that are on YouTube, again, just go to our socials on Instagram or on TikTok. The handle is at macro.optics. So just look that up and you will find us there. All right. Well, we appreciate everyone for joining. Good luck out there, and we will catch you in tomorrow's daily macro daily macro update with a special guest. So we'll see you then. Bye.